Hello, I'm Ruby Craven, financial planner, and I'm joined by my colleague Mashud Rahman, head of investments, and today we're talking about equities. So, Mash, what are equities?
So equities are stocks and shares of publicly listed companies traded on the global stock exchange. If you were to think of a company as a cake, buying equities is like buying a slice of that cake.
So the more shares you hold, the bigger slice of cake you have. What role would you say equities play in investments?
So in general, equities are classed as risk assets. Over the long term, we expect equities to provide the greatest return. However, when looking at the shorter term, equities have bigger fluctuations in value and can therefore present a greater risk than some other asset classes, such as fixed income.
And that's why having a well-diversified portfolio is so important, to allow you to get some protection in place against different market conditions. If you would like to learn more about fixed income investments and the importance of diversification in your portfolio, we have other videos in this series that explain these areas in more detail. Mash, we regularly hear on the news about challenging conditions for the economy, weak economies, strong economies, etc. How does what is happening in the economy affect equities? For example, how would interest rate changes affect the return on equities?
So in general, equities or global stock markets react to change. After the 2008 financial crisis, markets enjoyed a really nice decade of low interest rates and steady inflation. Now in a post-COVID world, we've seen interest rates hiked as well as inflation reaching double figures in some cases. Equities generally prefer interest rates to be low. So if you imagine a business looking to borrow money to help grow, it's more affordable when interest rates are nice and low. So this is why when we see interest rates increase, we often see the value of equities fall. And vice versa, when they fall, equities usually rise.
That's great, thank you Mash. Final question, how would our clients likely be holding equities in their portfolios?
Great question. So we use collective funds in our client portfolios, meaning that rather than buying individual stocks and shares, we use funds, which hold a mix of different investments within there. This means that the portfolio as a whole is lower in risk due to the diversification, but also allows the portfolios to use managers which are specialists in their respective fields. For example, for our US equity exposure, our portfolios will use US equity managers. So having this diversified and focused approach, in our view, leads to greater risk-adjusted returns over the long term.
That's great. Thank you for your insight, Mash. Don't forget we have other videos available in this series. Thank you for watching.